Hi everyone, I'm Paul. Welcome to Everything Money. If this is your first time watching the video, please subscribe to the channel and share this video with somebody who might find value in it. So guys, consumer staples are being discussed right now. They're always discussed when markets fall, when there's recessions coming. Why? Because people still want to eat cereal. People still want to eat Nestle. In fact, they might eat more of it because they're going to go out less. They're going to stay home and buy more stuff. But remember, just like I used to always hear from people, hey, I started a restaurant because people always got to eat. It's like, well, that's stupid. You can still overpay for a very good idea, right? Yes, people always have to eat, but there's a reason why restaurants are the largest failure rate out of any business. It's really, really difficult, okay? So same with consumer staples. Even though I like how conservative they can be, these prices can get bid up too much, and that's why you're watching the channel, to understand what to pay for these companies. So let's go to our stock analyzer tool. If you already belong to our software and you're a subscriber to our software, click on the 8 pillars, follow along. If you're not, you're going to love it anyhow. And you can obviously go to everythingmoney.com and figure out how to find it. So GIS is our first stock. General Mills, currently selling at $70 per share. Now, this is the 1-year chart. Look at this, guys. This is January. It is up from January 1st, even though the market's down 20%. So again, people hear recession. People hear bad markets. They flee to safety, right? That's why we kept in all of our videos in the last 2 years. If you're new to our channel, go back and look at our videos. We were called stupid because we weren't buying the high-flying hype stocks. We were buying the boring companies. This is a boring company. Let's go to our 8 pillars tab real quick. The only thing here that I'm not a huge fan of is issuing shares. It's not a huge amount, it's about 1% per year. Their debt, probably not a big deal. So we're just gonna go right to stock analyzer tool. Let's make some assumptions. Now look at this, guys. Boring A companies. Look at this. Growth in the last 10 years, 0.7% a year. Now, they had good growth in the last 5 years and no growth last year. But guys, General Mills ain't going to break any records about growth. Everybody knows who General Mills is. Everybody knows their stuff. But the good news is, for you as an investor, is when people find a company to be boring, they ignore the company. When they ignore the company, what happens to the stock price? And as an investor, what do you like it? You like it when the stock goes down. Because you've learned that if I like a stock at 100, I'm going to love it at 60 if I buy it for the right reasons. So let's make some assumptions here. Let's go with 1, 3, and 5% revenue growth. Now, here's why I picked 5 on the high side. First off, they did 4.4 the last 5 years, but also we have inflation hitting up. So if inflation stays sustained for a while, it will drive revenue up. Profit margin. I'm going to go with 11, 11.75, and 12.5. Free cash flow margin. I'm going to do 13, 13.5, and 14. PE. Guys, you should have a high PE if revenue growth is high, potential, or there's a moat. I would argue there's a moat-ish kind of aspect of this company, but I'm still not going to give it a PE. I'm still going to go with, it's still boring. And the lack of growth kind of tells me, that sucks. And the price of free cash, I'm going to go 13, 15, 17 on both PE and price of free cash flow. Guys, this is the art of investing. You are probably like, wait, how do you come up with these numbers? I'm just being conservative and starting from here. If my numbers end up working where I like the stock at the current price, my next step is to do more research, either in the community or on my own, to sit there and talk to others in our community about what they're finding in the company and what they like about it, what they don't like about it. And of course, guys, always a 12.5% return at least, because you can get 9 or 10% from investing in any boring old ETF. So if you want margin of safety, and if you want to buy an individual stock, give yourself a reason to with some extra margin. Hit the analyze button. Guys, just saying all red all around. Now, does this mean throw out the door? No, it just means now if you have our software, maybe you pick a price like right here, 51.58, and notify me. Actually, let's go a little bit higher. Let's change it to 55. Notify me when it hits there. You'll get a notification on your app and on the software and your email telling you, hey, the stock hit your price. Me personally, I am moving on from General Mills. I'm not going to ignore it forever. I'm just going to move on from it and wait till my notification hits, and I'll start doing more research. Company number 2, Unilever. Now, guys, everything I just said in the General Mills thing is going to apply to Unilever and all 5 companies that we're doing today. So, UL. Let's go to our 8 pillars. It's currently a $45 stock. Ooh, it's actually down a lot. 52-week high of $60. Oh, wow, look at 5 years, 65. Okay, 8 pillars. All right, revenue growth and profit growth are down. Not much down in the profit. $4 million on revenue of $116 billion. Not a big deal. So let's go to I just want to see the revenue and why it's down. So I go to the income statement. Interesting. Oh, there it is. Got it. Okay. So remember, this is a foreign company. They report a little bit differently. We get our data feed from a great source, but on foreign companies, always type in annual for your format. And guys, this is a boring company. Look at this growth. 54 billion 10 years ago, 55 billion last year. This ain't growing. This is worse than General Mills. This is worse than General Mills growth. So let's go to our stock analyzer tool and let's put in some assumptions. Oh boy. I'm going to go -1, 0, and 1. Profit margin. Tim just laughed, by the way. Tim just laughed. I'm going to go 11, 11.5, and 12. I'm going to go 10.5, 11.5, and 12.5. PE. Boring company. I'm going to go 12, 14, and 16. You're probably like, oh my God, Paul, that's so low. I know. But if they have low growth or no growth at all, so $45 stock, you're probably like, it's an 18 PE. Really? $24 got to almost fall in half? Guys, it's just math. It's just math. That's all it is. And it might seem conservative and crazy, but guess what? The good news is there's 10,000 stocks out there. Go to the next one. Next one, Kellogg's. Let's look at Kellogg. Again, just like, look at this. End of the year, beginning of the year, $64 a share. Now it's 70, up a little bit versus the S&P being down quite a bit. Let's go to the 8 pillars tab. Wow, a lot of debt here. Okay. A lot of debt. I've heard, I haven't verified this, that they are splitting off the company. Usually they'll try to do that, throw some debt off. Who knows? So do some research on that. Seems expensive from price to free cash flow area. All right, let's go to stock analyzer tool. Boy, these are not looking fun. Look at the revenue growth in the last 10 years, -0.3% a year. But they've had revenue growth in the last 5 years. Let's see if they made acquisitions to get that. I didn't look at that for General Mills either, but I should have. Yeah, not major acquisitions. In fact, they sold off something in 2020. All right, so stock analyzer tool. -1, 0, 1, 8, 9, 10, 6.5, 7.5, 8.5. PE. Oh, 10, 12, 14. I'm getting even worse on my PEs and my multiples. You guys are going to hate this. Guys, I know you're going to sit there and say, Paul, they're so conservative. That's the goal. There are 10,000 stocks out there. I will say this on blue in the face. It's okay to move on from one. Do what Warren Buffett says, which is you get unlimited pitches. Only swing at the ones that are good. You don't need to swing at everything. So just swing at the ones that are good. Analyze. Yep, it's got to fall about in half. I know it sounds crazy, but it might never fall in half. It might never, ever fall in half. But to me, that's okay. You don't need to buy every single company you see. Company number 4, KHC. So KHC, I believe, is Kraft Heinz. It is $37.83 per share. Very low profit margin. 5-year average is 3%. Last year was 4.8. Let's go to the 8 pillars. Oh, geez, oh, Pete. Geez, oh, Pete. Geez, oh, Pete. All right, let's do a stock analyzer here. This is all over the board. Oh my gosh, what do I do here? Guys, this is ugly. -2, 0, and 2. Profit, look at the profit margin all over the board. 3, 4.8, 6.3. Like, which one do I go with? Let's go with all of them. 3, 4.8, 6.3. Free cash flow margin, 8, 11, 8, 10, and 12. PE, 10, 13, 16. 10, 13, 16. This is going to be one of the widest range of returns of stock prices that I'll probably ever see. Oh my gosh. I would just avoid this. Like, to me, the numbers are so all over the board. I don't even know what's going on. There's so many X's. Like, to me, I just see it and go, I can't figure this out. Move on. Find another one. Stock number 5, MDLZ. MDLZ. Mondelez International. Mondelez International? I don't know how to pronounce it. Split off from Kraft Foods. Leading global player in snack arena. Oh, look at that. I love Oreos. Oh boy. Chips Ahoy. Well, I don't care what it is. I'm buying it because it's Oreos and Chips Ahoy. Just kidding. Do not do that. But I'm an Oreo addict. What I love the thin Oreos with the mint. Or, spoiler alert, I'm calling this right now. 15 years ago, I figured out, 16 years ago, you take regular Oreos, you eat it, and then you drink orange juice. It tastes phenomenal. You think I'm a psychopath and a sociopath right now? Please don't judge. Go do it tonight. If you're, vast majority of our audience, 96% is men. If you have a significant other, please text them and say on your way home from work, please pick up orange juice and Oreos. You'll be glad you did it. It was worth the video watch, but let's go look further. That alone deserves a subscribe, by the way. All right, so revenue growth. 2% drop in 10 years, but they're rebounding. I'm going to go 1, 3, and 5. 1, 2, and 3, actually. Profit margin, 12, 13, 14. Free cash flow margin, 9.5, 10.5, 11.5. PE, 12, 14, 16, 12, 14, 16, and a 12.5% return. I should give it a higher premium because it's Oreo. Man, these all have a ways to go. But I'm going to watch this one at 38. When it hits 38, because I think I'm going to add it to my watch list. When it hits 38, I think I want to take a further look at a deeper dive. So guys, remember, the reason you're watching this channel is you want to learn. And remember, the more you know, the less you will fear, because we fear the unknown. So when we see stocks falling, we all want to understand why that is. That's why you're teaching it from here. If you like this video, we have a video, click above for here for 10 stocks, the price we wanted to buy them at. It was a very popular video back in May. Thank you much for watching. Have a great day.